Good afternoon, everybody. Thanks for joining our quarterly educational webinar. This is something that we provide once per quarter to the participants of the 401k plans that we service to address different financial planning topics and help with education in that area. So a lot of times we'll address topics that people ask us about. They may have questions, or we may see many of the same participants ask the same types of questions. So we always feel it's important to try to address these topics as they come up. So I'm Brian Hartstein. I'm the host of the webinar, also one of the directors and principals here at Bayntree Wealth Advisors. And we help service your 401k plan. Most of you are utilizing a platform via John Hancock to provide the investment component for your plan, and we help to make sure that your plan is operating smoothly. We work with John Hancock and your company, the trustees, the HR department, as well as what's called a third-party administrator to make sure everything's running properly and smoothly. So we also help on the financial education side augment what John Hancock provides to the participants. So many times there's questions that John Hancock cannot answer because they go beyond the 401k scope of services, and so that's what we're here to do. We are here to help in just about any way we can. There's no cost for asking questions and utilizing our support and services. It's simply something that we do to help support the plan. So a couple housekeeping items. Number one, I do have a cold, so if I sneeze during the webinar, I do apologize in advance. And then if we have questions, many times we have questions, but when we do these, we are somewhat limited in time because we realize your time is valuable and you possibly might be working. Please feel free to contact our office after the webinar whenever you have time, and we can certainly hopefully answer any of those questions. So anyway, and also we are recording this webinar. So if you want to hear it again, or you know somebody that was interested in participating but was unable to for a variety of reasons, we will be providing the recordings of these webinars to your HR department to post to the website for your company. So you should be able to view them afterwards or tell whoever wanted to be on the webinar but could not that they'll be posted and they could view it at their leisure. So again, we appreciate the opportunity and your time today. So real quick, just introducing the team. So the team here at Bayntree that helps service your 401k plan is composed primarily of 4 parts, although there are other people working on it as well. I myself, Brian Hartstein, I'm one of the directors and principals here, and I've got a tremendous amount of experience going way back, well over 20 plus years in the qualified plan 401k area. And I help work with the trustees of your plan, owners of the company, and your HR departments to make sure everything's running smoothly. Chris Roger is one of our financial advisors here on staff. He's dedicated to working with you and your plan and answering any questions and being as helpful as he can to make sure that your experience is optimal and if you need any help along the way. He is very skilled in financial planning, the 401k plans, as well as other financial concepts. So if you have any questions whatsoever, whether it's how do I set up my account, how to allocate investments in my account, how to tolerate risk, or how your account might integrate with the other investments that you have for retirement planning or investment planning or any particular area, please feel free to call our office, talk to Chris. You can always talk to myself as well, but mostly Chris will be your main contact for that, and he can certainly help you in those areas. And then we have Rena Blanco, who's dedicated to help working with your plan in terms of just about all operational aspects, and Megan Shy, who helps assist Rena. So that's your Bayntree team, and that's who's here to help you make sure you have the best experience possible and utilize your 401k plan and the financial services and educational support we provide here to help you along the way and get you where you want to go in terms of your goals in retirement. So again, we're going to jump into a topic that, again, we get lots of questions on, not specifically in the 401k plan, but has to do with IRAs. Roth IRAs, traditional IRAs, which one's right for me, how do I use them, gosh, how do they work? So we're going to kind of take it from a high-level approach and work our way down. So again, some of the areas we're going to talk about real briefly are what are IRAs, ages in terms of when you can use them, do you have to have earned income, contributions to them, how they grow, distributions from them, and then, hey, which one might be right for me? So those are the areas we're going to tackle here today. But what are IRAs? Okay, they've been around for quite some time, and it stands for an investment retirement account. And specifically, it is a specialized savings account that is geared for post-retirement funding. It is built into the Internal Revenue Code and is put there by Congress and the government to help you save more for retirement. The advantages of each, the Roth and the traditional IRA, are different, but they're primarily both geared for the same thing, which is to help you save for retirement and create dollars that you can access when you retire that you can help live your lifestyle. And that's pretty simple. So that's what they're there for. And they come in two flavors. We have the traditional IRA, which most people are probably more familiar with because they've been in existence much longer. And then we've got the Roth IRA. And the differences between the two is where many questions come up. But those are the two types of IRAs that we're going to be discussing today. There's another one called My IRA, but we're not going to get into that today. We're going to focus just on the Roth and the traditional. And there's special tax features depending on the type of IRA we're talking about. And they're going to be in three primary areas. Whether you get a tax deduction for putting monies into one of these IRAs, meaning if you contribute $1, does the whole dollar go in or is it taxed first? The second feature is tax deferred. Do the monies in these accounts grow free from tax so that if you earn $1 while it's inside of your IRA, is it being taxed? And then the final tax area we're going to talk about is when the monies come out of the IRAs, when you choose to take them out in retirement, are they taxed? So when I go to get my monies, will they be taxed then? So is it tax-free? So those are always the three tax aspects that we're discussing when we deal with IRAs or even 401ks and other retirement plans. Is it tax deductible? Does it grow tax deferred? And do the monies come out tax-free? You're never going to find a vehicle that will produce all three, but it's important to understand which IRA we're looking at and the tax features of each one. So we're going to make one assumption for this webinar, and I'm going to use one of my children's favorite characters, which is Yoda. And like Yoda, we're going to assume you will live for a very, very long time. So that when you get to retirement, hopefully you've got your 401k account, and you've got vehicles that you used for savings, such as IRAs, and you're going to go access them and take monies out year by year because you're going to be in retirement a heck of a long time because you're going to live a long time, just like Master Yoda. So when we look at a Roth IRA, you can make a contribution at any age. So you could be 85, 55, 35, 25. And you could put a contribution into an IRA. It's not limited by age. If we're looking at a traditional IRA, you must be under 70 and a half to make a contribution. So if you're 75, utilizing a traditional IRA would be precluded for you, meaning that you cannot use one. You'd be looking at a Roth IRA. So there is an age limitation on traditional IRAs. There is not for Roth IRAs. So income. If we're looking at a Roth IRA, that does require you to have earned income, meaning W-2 type wages during the year. Now, there can be some income restrictions for contributions, and what that means is if you make certain amounts of income, you can be precluded from utilizing a Roth IRA. For example, if you file jointly or you're a single filer for tax purposes, you might not be allowed to make a Roth contribution. And if you'd like to know what those limits are, you're curious if you fall in that range, please call our office, talk to Chris, and he can help you specifically figure out if you can make a Roth contribution or you can't based on your income. For a traditional, and there's no limitation if you're covered by a retirement plan at work, meaning if you're eligible for a 401k, and if you're on this webinar, it means you're probably eligible, you can still contribute to a Roth IRA. There's no limitation for you. So when we look at a traditional IRA, just like a Roth, that requires earned income, and contributions can be made to it regardless of your income level. Okay. However, you might be limited if you're covered by a retirement plan at work. And since you're on this call, you are covered by your retirement plan at work. So there are limitations on whether you can make a traditional IRA contribution in terms of your income level. So again, if you have questions about whether you qualify, what your income level is, and whether you could possibly make one, again, call our office, talk to Chris, he can certainly help. But those are some of the basics between, do you have to have earned income, and are there limitations on each of those IRAs? Now, if you are going to make a contribution, and let's say you are eligible to make one in both cases, for a Roth IRA, it's not tax deductible. So you're using after-tax dollars. So it's different from your 401k, meaning if you put $1 into your Roth IRA, you've already been taxed on that money. So you do not get a tax deduction for a Roth IRA. That's important to remember. And for 2016 and last year and 2017, maximum you can put into a Roth IRA is $5,500 unless you're over age 50, and then you can put $6,500 in. For a traditional IRA, that is tax deductible. So you're using pre-tax dollars, meaning if you put $1 into your traditional IRA, that has not been taxed yet. So that's a big difference between Roth IRAs and traditional IRAs, is whether the contribution is tax deductible or not. And for 2016 and 17, the limits are the same as they are for Roth IRAs, $5,500 if you're under age 50 and $6,500 if you're over age 50. If you said, I want to do a little in each one, and you're eligible to do that, the combined limit is still $5,500. You can't put $5,500 in one and $5,500 in the other. You have the same cap whether you're using one type of IRA or both types of IRAs. So that's important to note. Now, the money's inside these plans. Let's say, hey, we're going to use one. I put money into it because I qualify. And in a Roth IRA, your funds grow tax-free or tax-deferred, meaning they are not taxed while they're growing inside your Roth IRA. So if you put $1 in and it's in your Roth IRA and it makes $1, it's not taxed. And it's the same for traditional IRAs. If you have $1 inside your traditional IRA and it grows to $2, that dollar gain's not taxed as well. So for both types of IRAs, the growth of the monies is the same. They are protected from taxes. So just to recap, traditional IRAs, we have a tax deduction, and they grow tax-free. Roth IRAs, we don't have a tax deduction, but they also grow tax-free. So that's kind of where we are right now in the presentation. Now let's look at what happens when the monies come out. You're in retirement. You're saying, hey, I need some cash. I want to go take a trip. I want to do some fun things. So when we take money out of the Roth IRA, the distributions can be tax-free if the account's been open 5 years. So let's assume our account's been open 5 years. We go to get money out of it. It's tax-free. So we did not get a tax deduction for the monies that went into it, but it grew tax-deferred, and the monies come out tax-free. So that's really important. So when you go to get that money in retirement, as long as it's been in that account for 5 years, it comes out tax-free. Traditional IRAs work differently. If you take $1 out of your traditional IRA account when you're in retirement, it's like that dollar was earned by you during that year, and you will be taxed on it. Remember, we got a tax deduction for the monies that went into the traditional IRA. They grew tax-deferred, but now they're going to be taxed on the way out. So Roth IRAs are taxed on the way in and not taxed on the way out. Traditional IRAs are taxed on the way in and not taxed on the way in and taxed on the way out. So that's the real big differences between those two. For Roth IRAs, you're not forced to take money out if you don't want to, meaning some people are at a certain age and they just say, I don't need the money for retirement. I'm going to leave it in there. And you're not forced to take any money out. With a traditional IRA, once you hit 70 and a half, whether you like it or not, you're going to be forced to take some money out, and that's computed by a table that the IRS puts out. And if you have questions about how that's done, we can certainly answer your questions about how those calculations work. But if you're already taking money out of your traditional IRA after 70 and a half, you might satisfy that minimum required distribution. But if you say, hey, I'm 75, I don't want to take money out this year, you may be required to. Okay? So that is also a big difference between the two IRAs. Roth IRAs do not have minimum required distributions. Traditional IRAs do. Well, what if I need to get my money early? I can't wait for retirement. Something came up, and I want to try to get my monies early out of these accounts. So with Roth IRAs, your original contributions, but not the earnings, can be withdrawn anytime without penalty. So even if you haven't waited those 5 years and you've contributed $5,000 into your Roth total, you can pull the original $5,000 out. There's no penalty for doing that. If you try to access the earnings, they will be penalized before that 5-year period is up. You can make some qualified purchases up to $10,000 of earnings that may be withdrawn penalty-free. Again, if you have questions about what qualifies, please call our office. And a traditional IRA, if you try to take money out before age 59 and a half, you are subject to a 10% gross penalty. Meaning if you took $1,000 out at age 55, not only are you going to be taxed at your tax rate on the $1,000 for that year, but the 10% penalty would apply on that $1,000, so you'd owe an extra $100 on top of the taxes. The government wants you to keep these monies inside retirement plans for retirement, and they say, hey, if you're going to try to get them early, we're going to slap you on the wrist a little bit, and that's the penalty. Some exceptions do apply to the traditional IRA in terms of trying to take money out early and not have it be penalized. And if you have questions about that, please call our office. But again, for early distributions, there's a difference between the two. Roth IRAs, you can always get your original contributions out, penalty-free. Traditional IRAs, any monies that come out before age 59 and a half will be subject to a 10% penalty unless it falls into the exception. So a pretty big difference there. So we just covered a lot of ground. And you're probably thinking to yourself, if you're out there and you've kind of listened the whole time, took in all the information, you're saying, well, great, which one applies to me? Which is the better choice? And unfortunately, I'm not going to tell you right here which one is. I'm going to say it depends. It depends on a variety of factors, including your age, your planning situation, your income level, and some other specifics. So if you're looking at making one of these and you're not sure which fits you best, please call our office. We can certainly guide you and tell you which might be the best tool for you to utilize. But for Roth IRAs, as a general rule of thumb, it's usually better for younger people that have more time until retirement and also can satisfy that 5-year waiting period. So that if you put money in today, for the monies to be able to come out on a tax-free basis, you've got to be able to wait 5 years. And normally we're looking at younger people below probably age 60 in terms of making Roth IRA contributions. Also, you really are not looking for a current tax deduction because remember, as we said before, Roth IRAs aren't tax deductible. So you're not going to get a deduction for the monies that are put into those. So if you're trying to reduce your tax burden, Roth IRAs will not help you. And when we run these numbers for people, especially younger people, and looking at making contributions, taking into account tax rates, and then withdrawals, Roth IRAs might outlast a traditional IRA over time, depending on how it's accessed, what your tax bracket is, and what your age is. But those are some rules of thumb that we use with Roth IRAs. With a traditional IRA, when would that be a good use? Well, number one, if you're looking for a tax deduction today. If you said, I've got some taxes to pay, I'd like to reduce my tax burden, and I can qualify to put money in a traditional IRA, that's a good tool. Because if you put $5,000 into a traditional IRA, that's going to reduce your gross income by $5,000. So you wouldn't have to pay the taxes on that $5,000. And for those people who are assuming that taxes will be lower than when they retire, whenever that is in the future, traditional IRAs might be a better choice because when you pull the monies out in retirement, remember they're taxed then, not now. So if you're in a lower tax bracket then than you are now, it might be better to use that traditional IRA. Again, those are just some general rules of thumbs when we look at each of those IRAs. But whether one specifically applies to you or not is going to depend on the facts and circumstances of your situation, such as age, income levels, what other planning that you may have done in conjunction to your 401k accounts, and how that all ties in together. And again, we're here to help. We're here to provide education there. There's no cost for utilizing our services. That's what we do to help service the 401k plans and the participants that we work with. So if you do have any questions, financial planning related or other, please feel free to call our office. If you talk to Ren or Megan, you can certainly ask for Chris. I'd start with him or myself, and we're certainly here and happy to help. So again, we appreciate everybody's time. Again, this will be posted as a recording to websites, and we will be doing these once a quarter approximately on different topics to help people become better educated about different financial planning tools, concepts, and how you might prepare yourself better for retirement. And that's what we're here for. So anyway, I thank you for being on the call. I thank you for your time, and good luck. Thanks.